Hello and welcome to Portfolio Matters, weekly update, week 35. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. It's good to be back after my week off. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith.
Well, we have another busy week. So there was no real economic news this week, but there was quite a lot of economic data. So we had PCE inflation year on year for July in the US, and remember that is the Fed's preferred measure of inflation, and that came in hot again. Came in at 4.2% in July, which was above June and above expectations. And core PCE inflation came in at 3.6%, again above June and again above expectations. And those elevated inflation numbers are feeding through to consumers' expectations of future inflation. So the US Michigan 1-year consumer inflation expectations now run at 4.6%, which is well above the Fed's inflation target of 2%. And that may feed through to wage growth, and then you have self-sustaining inflation. Consumer sentiment fell to 70.3 in August, which is well down on July, although it was slightly better than expectations. And so consumers are feeling less good about the world because of the Delta variant and supply chain disruptions, etc. Now, manufacturing PMIs in the US came in as reassuring, actually. They came in at 59.9 in August, which was above July and above expectations of 59.0. And the new orders PMIs came in at 66.7, well above July. So that is reassuring, and it was also beat expectations. In the UK, we had an absolutely extraordinary mortgage lending figures for June, which was an all-time record. And in July, that came off. So actually, mortgage lending fell by 1.4 billion. And we will see a chart of that in a sec. And that was massively missed expectations of net lending of plus 3 billion. Consumer credit in the UK is just not recovering. Consumers aren't borrowing. So July figure massively missed expectations, and actually consumer credit shrunk in July. And we will see a chart of that in a moment. Essentially, consumer credit is going nowhere and has not recovered to anywhere like pre-pandemic levels. In the EU, inflation ticked up to 3%. And next week, the ECB are meeting, and there is speculation that the ECB will have to start tapering QE. And as you will see later when we go through the charts, Eurozone bond yields in the periphery, so Greece, Italy, and Spain, are starting to tick up. And core in EU inflation was 1.6%, which beat expectation of 1.4. Now, in China, we have talked in previous weeklies about how China is slowing, and we got further evidence of that this week in the flash August figures for the service PMI, which massively fell to 46.7 from 54.9 in July, which was well below expectations, so a massive miss. And the same was true of the composite PMI. We go through some charts. So this is consumer sentiment in the US, and it's taken a big knock. I mean, it's amazing how far it's fallen, actually.
Back to the lows of COVID, isn't it, Keith?
Precisely. And obviously there's a lot mixed up in that, but that is before the fall of Kabul, because actually that is this month, isn't it? August. So yes, that will include some political fallout. This is the ISM manufacturing PMIs, which seem to have bottomed, which is good news. And unemployment claims had a good week. So there was a big fall in unemployment and in the US. And it seems like the US economy is recovering actually quite well and consistently week on week, despite the Delta variant. Now, this is UK mortgage lending, which had an extraordinarily bad month. So consumers net paid back mortgages last month for the first time since the bottom of the pandemic. And so
that's just inconsistent with the house price rises that we're seeing.
Well, it seems that purchases were really brought forward in July.
Yeah, makes you wonder whether it's going to go the other way.
And consumer credit is extraordinarily low. So you wonder whether that's a function of the fact that government largesse has boosted people's savings and they don't feel the need to yet start borrowing. But you're not going to get money supply growth unless the banks start lending and people start borrowing. And this is the EU inflation rate, which is on a worrying trajectory, rising strongly. And the core inflation rate is following it. Now, in China, the PMAs are coming off, and they're coming off quite a nasty fashion. So we have talked about this in previous weeks. Credit growth has slowed, and now you're seeing the PMIs dropping below 50, which is into contraction territory. And that is the composite. Okay, so then we're now going to do a section on the Fed and the Fed's inflation narrative, which is inflation is transitory. And I'd like to thank our Discord member, Richard Wilk, for sending us these charts. So this is all from the most recent Fed speech. And essentially, the Fed is saying that it expects inflation to be transitory because it is being led by inflation in durable goods. So what this chart shows is absolute spending on services, which is the top line, and they have dropped and have not recovered to pre-pandemic levels, whereas the price of durables, the demand for durables, expenditure on durables has risen sharply because people were stuck at home. They couldn't go to the restaurants. They bought stuff, essentially. And the world economy has been unable to supply durable goods to meet demand. So you're seeing lots of supply chain disruptions and demand for durable goods exceeding supply and massive inflation in the price of durable goods. So what the Fed is saying is that this is a temporary phenomenon. As the demand for services comes back to normal, the demand for durable goods will ebb and the supply chain disruptions will also disappear, and the high inflation you're seeing in durable goods will dissipate. So if you think about cars, the disruption to the car manufacturing will ease, car supply will come back online, and car inflation in the car market will dissipate. And they're saying that wage growth is currently quiescent, and therefore you're not seeing the inflation in durable goods feeding through to demands for higher wages, and therefore a self-sustaining cycle of wage demands leading to higher inflation. But a reminder of where we are. Inflation in the US is very high. It's at 6.8%. I mean, it's not just slightly above the Fed's target, it's massively above the Fed's target.
And of course, the Fed wants to have a narrative that inflation is going to fall back and they are coming up with any possible reason they can to say why it's high and why it's going to fall back. And to explain that our current level of inflation in the US on durable goods is perverse, given what's actually going on in the world economy. But it seems to be that it satisfies the markets and it achieves the Fed's objective of trying to keep inflation expectations low.
Well, I am reminded, Richard, of the ghost of Arthur Burns, who, in the early 70s was the Fed chairman. And again, when inflation was rising then, he put it all down to transitory factors. And everything that came up was a transitory until it took him years. And then by the time, so we have the core CPI index is one of his creations because he wanted to take out energy and food. And eventually he tried to take out everything.
Apparently, I was reading this morning, if you run the current US inflation rate on the basis of the same statistical basis it was run in the 1980s, the current inflation rate in the US is about 14%, 14%.
Wow.
Now, it's not to say that anything, but there has been huge manipulation of the inflation figures.
Yes. Well, of course, the change from arithmetic to geometric means has been massively reduced the headline inflation number. Okay, now on Portfolio Matters, we are concerned about inflation, as regular viewers know. And we think we are seeing broad inflationary pressures, that the rents in the US are rising, and rents to make up about a third of the inflation basket, and they're just coming through now. And Nordea are saying that the rise in rents in the future will keep inflation high throughout the end of the year. So it's not just durable goods. You're seeing broad inflationary pressures, and wages are rising and unemployment is falling. And as you will see shortly when we show you the chart, there are now more job openings than there are job seekers. And in order to close that gap, employers are going to have to bid for labor and bid up wages. So you should see wage inflation. In addition, consumer inflation expectations are rising, and it's an open question as to how much that will then feed through to wage demands, and then you then get a wage inflationary spiral. So in conclusion, I mean, our pushback would be there's a great deal of broad inflation. We're seeing inflation in lots of places, and there's a lot of uncertainty. So given that there's a lot of uncertainty, which is what the Fed's talking about, why have they got their foot to the monetary accelerator? And interest rates in the US are about 5% below the Taylor rule. So they're admitting they don't know what's going on. There's a great deal of uncertainty, but they're committed to pumping as much money into the economy as they can. It's extraordinary. So we go through some charts. This is the City Inflation Surprise Index. Rents, Nordea are predicting that rents will rise strongly throughout the end of this year. There are more job openings than there are unemployed, although the labour participation rate may rise and hopefully fill that gap. You need to get people who have left the labour force to come back in. And these are consumer inflation expectations. The white line is 5 to 10 years. The blue line is this year, very elevated. And long-term expectations are creeping up and well above 2%. And you are seeing in certain sectors very strong wage inflation. So this is from the UK, and this is a lorry driver who tweets, and he was saying he arrived at work today to discover he had a £7 an hour pay rise. That's 40%. And the thing about wage rises is they're sticky.
Yeah. And I would say in this morning's City AM, Keith, bin collection delays ongoing amid driver shortage. So this is London. But of course, why is there a driver shortage? Well, presumably bin drivers are leaving for the 40% pay increase they're getting as delivery drivers. And so what will the councils have to do? They will have to increase bin lorry drivers' pay accordingly. And what will that do? That will put up our council tax. What is that?
Yeah.
That's inflation.
Absolutely. But as you say, Richard, when one sector, wages rise in one sector, it drags wages up elsewhere.
Yeah.
Because you have to retain your driver. Otherwise, he's going to go and work for DHL.
Because staff are fungible.
Yeah. So, and once wages rise, they're very difficult to negotiate back down. People, adjust their spending to the higher wages, and it's very difficult to try and cut them again. And just a reminder that we are 5.2% below the Taylor rule in the US. So the monetary policy is extraordinarily stimulative, and it's the most stimulative it's ever been, actually.
And with hugely stimulative monetary policy comes inflation. And so there are a lot of, there are overt and covert factors all pointing to a real potential inflationary problem. And fundamentally, what would happen if the Fed were to put up interest rates by 5%? The US dollar would crash.
Exactly. If they were actually to get to the Taylor rule, that would actually be incredibly bad for the world economy, given how much debt we have. So as Rich was talking about earlier, keeping interest rates low, man, you slowly inflate away the debt. And house prices in the US, as we have discussed, are on a tear.
Yeah,
and
it's interesting, I think, Keith, because it's this is a 20-year graph, and so house price year on year increase is the highest it's been in 20 years.
Yeah, wow. And we know that high house prices are now putting off home buyers in the US.
Oh, this is a nice graph. So there's been a lot of mortgage refinance going on. So the total mortgage lending in the US, a huge amount of it now is mortgage refinance, which is effectively borrowing money for people to spend, which is inflationary. And if you look, the refinancing now is higher than it has ever been, and it is about 3/4 of the total mortgage originations.
Well, some of that is not necessarily equity release, Richard. Is that if you're on your old mortgage is more expensive than your current mortgage, then you're going to refinance, and mortgage rates are very low.
That's true, Keith. Yeah.
So anyway, thank you to Richard Wilk for putting us onto that. Richard, do you want to talk through peak globalization?
Will do, Keith, yes. So this is an interesting chart. This is the Trade Openness Index, and we don't know how that's calculated, but what it's showing is that from 1870, well, probably from actually 1940, really, the Trade Openness Index was on a continual increase up to around 2008, at which point it sort of peaked and it is now reducing. And that is very significant because globalization, I think, as in possibly the next chart shows, this is basically saying the same thing, that world trade as a percentage of global GDP has plateaued for the last 10 or 12 years. So there is no more growth in world trade as a percentage of GDP. And what that means is that the disinflationary pressures that came around with globalization, the moving of production to low-wage countries, which enabled developed countries to import cheap goods and work in a low inflation environment. that environment is coming to an end. And that is another inflationary pressure. So this is a series of 3 graphs showing the US broad money, or country broad money supply versus CPI. And I think the link has broken between broad money per capita growth and 5-year CPI growth. You can see that from probably early 1900, the two have moved more or less in step. And since 1999-2000, broad money supply has gone up very significantly, and 5-year CPI growth has not moved. And I think the point here is that the reduction in globalization is going to create a massive inflation shock, potentially. Keith?
Well, one thing I'd say, Richard, is so the mechanism for that is that you get inflation when demand is greater than supply. And by outsourcing all our manufacturing to China and cheap labor there, you had essentially infinite supply. So you had no inflation. So you could increase demand by, pumping the economy full of cash, but you didn't have inflationary consequences. And now, if you're getting a rowback from globalization, then you get supply constraints once more.
And this graph shows the break in the linkage between US productivity and workers' wages. And where has that additional money gone? It's gone into corporate profits. And so workers' wages have suffered at the expense of corporate profits.
And I would also say that I put in this black line in the financial crisis. And I would say, and bear in mind that this is a percentage graph. So because the dark blue line starts at a higher level, if it increases at the same percentage rate as the blue line, the gradient will be higher. It would seem after the peak in globalization, it would seem to me that wage growth is actually growing in line with productivity again.
Yeah, this is also interesting, Keith, because the petrodollar system and the break in the linkage is very clearly at the introduction of the petrodollar system. But what happened with the introduction of the petrodollar system was that simultaneously the world went off the gold standard and governments started printing fiat currency. And it rather looks as if this fiat currency has gone into financialization of the economy as opposed to reward of workers for their work. And we know that the horrendous mess that our central banks are in now is due to the financialization of economies. So, in summary, global trade peaked 61% of world GDP in 2008, hasn't risen since. And the economic shocks that globalization caused over a number of decades appear to have passed. So do we expect additional inflation dynamics to begin to reassert themselves? And another contributor, I would say, to the reduction in globalization is the realization of the dangerous situation you put yourself in when you're totally dependent on supplies from a foreign country. And COVID has shown that countries highly exposed to having to import necessary supplies puts them in a very weak position when things go wrong with that supply chain for whatever reason.
Absolutely. Okay, so moving on to the impact of the Delta variant on the European economy. And there was an interesting piece in the FT this week. So this is the number of verified COVID cases in Europe. And you will see that recently we have had a resurgence of COVID cases in Europe, primarily in Spain and France. So Spain is the yellow and France is the dark brown. And it has had a surprisingly small impact on the European economy based on live data. So this is the OECD's real-time activity tracker. which uses mobility data and Google word searches to create an index of consumer sentiment and activity. Now, this is not an index of economic activity, just shows that people are moving around. And what is clear is that people are adapting, that despite the fact that Delta is resurgent, people are getting on with their lives intra-country. So visits to shops and restaurants, I mean, I find this extraordinary, that actually it's been okay.
Yeah.
Including in France. France has come off a bit. Spain, where there was another resurgence of the Delta variant, is fine. But
until you get to hotel bookings,
exactly,
international travel.
Yeah, so there are loads of annoying restrictions on international travel, as I discovered as I came and went from France, and that's really putting people off. So international travel, hotel bookings have not recovered and are well down on pre-COVID levels. Although this week, you may have heard that the head of Ryanair was saying that Ryanair had had a very strong recovery and they were expecting to be back at pre-pandemic levels of revenue and activity by the end of the year. But that is slightly contradicts what other airlines have been saying. But Ryanair say they're doing very well.
Interesting. Of course, if you're of Spain, which is highly dependent upon the tourist sector, and your hotel sector is minus 70% down on occupancy, your economy is taking a big hit.
Absolutely, yep. But employment levels are rising. You know, these are demand for jobs. These are job postings, and they're well above pre-pandemic levels in Germany, France, and Italy. Though, as Richard has said, Spain is trailing, but seems to be getting back to parity as well, despite the lack of tourists. But in Germany, industrial production seems to have taken a hit from the supply chain disruptions. And so this is German truck mileage, which mainly involves Germans moving around manufactured goods, apparently. Okay, moving on to some other charts. Richard.
So this is the rolling 5-year cumulative growth in CPI and broad money, which I think we looked at before, didn't we, Keith? Yes. So the US has massively increased its money supply recently, and it is massive, isn't it? 5-year cumulative growth of 60% in broad money per capita. CPI, and this is the same graph for the UK, and then we have the same graph for Japan, where you'll see with those two countries, the broad money growth is much lower than in the US. And the US M1 has gone parabolic, basically.
Yeah.
And this is the current CPI indices for those three countries. So Japan, whose broad money hasn't grown very much, 0.2%. UK, whose broad money has grown a bit more, 2% inflation. And the US, whose broad money has grown fantastically, 5.37 CPI. Which seems to point to a clear linkage between money supply and inflation now. And given that our view is that money supply has to continue increasing to sustain the government levels of government debt, and also I think probably to sustain markets, one is looking at these levels of inflation going up.
Absolutely. Well, this just shows the traditional link between money supply growth and inflation, a la Milton Friedman, is absolutely there. You know, despite what the Fed's inflation narrative may be saying.
And John Law, I believe, he demonstrated it very nicely in 17th century France, didn't he? We've known it for a long time, basically.
Yes. He was exiled and died in penury.
Okay, this graph is just, so this is IMF special drawing rights issuance. Now, I think special drawing rights are incredibly opaque, but basically the IMF can issue these special drawing rights. And in the 2021 general allocation, it issued $456 billion, although at the top it says 650, but $450 billion of equivalent SDRs. Well, this is money printing.
Yes, but what it shows, Richard, is that the developing world has missed out on the money printing party. And so the IMF's come to their rescue and printed a load of money for them.
Yeah, I wonder if they come to the rescue of the European Central Bank, frankly.
Now, moving on, this is Chinese service PMIs, which, as we've discussed previously, took a huge hit in last week, in August. But the credit impulse has had a small tick up. Now, is this the bottom? The thing is, if you look at this chart historically, a small tick up is not necessarily the bottom of the trend. So something to be aware of. And news out today on that front is this is the price of Evergrand bonds. And as we discussed, I think last week, Evergrand is the biggest properties developer in the world with enormous debts. And this chart is showing that the bond market is expecting Evergrand to default. Yeah. And not just that, Evergrand to default and there to be a very low recovery rate. Now, this is the Atlanta Fed's nowcast for Q3 2021 US GDP, and they have downgraded their forecast for Q3 GDP a lot in the last week. They are expecting strong GDP growth, but much less strong than they had previously expected. And the economic surprise index, which is the orange line, has been very negative.
Yes, so personal consumption expenditure in the US $1 trillion. So basically the service sector personal consumption expenditure took a huge hit in COVID and has just about recovered to where you would project the trend line to be. The goods consumption expenditure, as we discussed earlier, has gone up massively and is staying high. Yeah,
I mean, that does look absolutely unsustainable.
Yeah, and real personal incomes have dropped back from the pandemic largesse of the US government, have dropped back to trend growth.
So there is a contradiction there, Richard, because this chart shows that incomes have dropped back, but durable goods expenditure remains elevated. How does that work?
Do you remember the savings rate went up hugely, didn't it? With the I suspect what's happening is that the money that people received of the pandemic support is being spent on durable goods.
Yes.
And so the personal income that went up was saved for a while. It's now being spent, and they're not receiving, and the income people are receiving now, their wages and salaries, not anything from the US government.
Right, thank you. Okay, now, supply chain disruption. So container rates continue to rise extraordinarily. So earlier in the year, so at the beginning of the pandemic, you've seen that container rate from Shanghai to New York was about $2,500. It's now $14,000. So that's sixfold rise.
The interesting thing about this graph, Keith, I think, is that we've been commenting on it for the last 7 or 8 months. Yeah. And we've been saying for the last 7 or 8 months, look at how it's going up, and it hasn't stopped.
No, that's absolutely right. But there has been a big increase. The latest rise in the index was caused by the closure of these Chinese ports. Is it Ningbo? They closed it due to one COVID case, and causing massive supply chain disruption around the world. Now, this is an interesting chart, and this shows US home sales. And first thing to point out is the absolute level of new US home sales has never recovered to the pre-Great Financial Crisis levels of pre-2007, 2008. But the point of this chart is actually to show the decline, in fact, the disappearance of US starter homes. So the blue area of the chart is homes for sale under $150,000. And you can see they have completely disappeared. And the orange area of the chart is new homes for sale between 150 and 200K. And they have all but disappeared. So the only... Go on.
Like I say, Keith, you could do a sort of interpretation of this, which is that in 2002, your starter home cost $100,000, let's say. And in 2021, your starter home costs $250,000, the mid of the grey line, the grey band, which means in the last 20 odd years, the price of a starter home has gone up from 100 to 250, i.e. 12 times.
Yeah.
Sorry, not 12 times.
But 2.5 times.
2.5 times, yeah.
2.5. But when we talked a couple of weeks ago, Richard, about the link between interest rates and the maximum price you could afford for a house based on principal and interest payments. And this just shows the effect of falling interest rates. And we're now reached almost the theoretical maximum that you can pay for a house based on interest rates of 1%.
Yes.
And the Fed is kind of trapped because, as you were talking about earlier, if they raise rates, then house prices drop, and that causes house price sales, or people get trapped in negative equity. That's bad for the economy, etc., etc.
Yeah, and also, one of the keys, I think, one of the legs of U.S. economic policy over the last 20 years has been house prices, the feel-good factor, make citizens feel wealthy, and you can't do that if interest rates are tending to approaching zero, and there is that cap on what you can afford. The affordability cap becomes principal repayments. House prices can't go up anymore. So you lose that ability to manipulate the economy by rising house prices. And if you want to continue creating the feel-good factor, what do you do? Well, the only other place you can create it is the stock market.
That's a very interesting point.
Well, I mean, we'll see, won't we?
Well, and on that front, let's move on to equity markets. Oh, surprisingly, they had another good week. So we'll show you the chart of the S&P in a second. So the all shares up 0.7%. The stocks 600 Europe was up 0.9%. The S&P continued its relentless rise, up 1.5% last week. The Nasdaq up 2.6%. The Japanese Topix up 4%. Bitcoin up 5.2%. And sterling rose slightly, up 0.4%. And I just wanted to remind everyone of the absolutely extraordinary performance of the S&P 500. You look at it, it's going up in a straight line. There are hardly any drawdowns. VIX is actually very subdued. So people aren't expecting any volatility. And that is being driven by extraordinary growth in long-term earnings expectations. So, you'll see this IBES do aggregate earnings expectations data, and you're now expecting long-term growth in earnings for the S&P 500 of over 20%. I mean, it's just insane.
It is insane.
And
it is insane because
it is insane.
Yeah, because there is some natural limit to the level of profitability.
Absolutely. And we're seeing wage rises. So, you know that companies are having to bid up wages. And we've just seen they've raised the price of the wages of truck drivers in the UK by 40%. Yeah, that's going to hit profit margins. And you see, and that is on top of record high corporate profitability. So they're expecting massive profitability growth on top of record high profitability. And that is mainly being driven in the US by the technology sector. So the thin line is the profitability of technology companies, that's their profit margins, and the dark line is everything else, whose profits have actually been falling over the last few years and have gone nowhere over the last 2 decades. So what the market is essentially saying is the profitability of technology companies is going to go through the roof from already high levels. But this is a breakdown of last month's earnings revisions sector by sector for the S&P 500. And you'll see every sector has had positive earnings revisions, led by energy, and actually some basic materials, industrials, technologies, actually quite subdued. But earnings revisions positive for both 2021 and 2022. Richard.
Yeah, so graph of Bitcoin, which is flirting around its recent highs of $49,000 to $50,000. It has had a bounce back from the level it dropped to a few months ago, a month and a half ago. Various people are projecting that it's going to go up significantly. And I'm not sure about Bitcoin, actually. Next graph is Ether, which is behaving very differently to Bitcoin. And I noticed it's actually up 4% as we're recording this, it's up 4%. That's effectively 4% on this above where I took this graph off. And there is, Ether is being used to drive these non-fungible token platforms. And there is increasing demand for Ether in that usage. Plus, a lot of Ether is not available. It's held by people in cold storage, to coin the phrase. So the free float is being squeezed quite tightly. And I think that is not, that demand dynamic doesn't exist in Bitcoin. And if you look at the log chart of Ether, it bounced late July off the log trend line, and it looks like it might be heading up to the top log channel line, which, as I said a few months ago, if it were to do that, it's actually very hard to interpolate that logarithmic chart manually, but it would be quite a lot higher than it is now. So I think that is interesting. Shall I do the commodities, Keith?
Yep, use that.
So aluminium, which we're going to talk about in a little bit, had another very good week, up 2.3%. Cobalt and copper sitting around doing nothing terribly much. As you know, copper had a big rise, and it is consolidating. Chromium up 3.4%. Chromium is an important element in steel production. Iron ore has stopped its meteoric drop, and it only fell by 3.6% this week. Lithium unchanged, neodymium down 1%. Nickel up 2.6%. So I think nickel had a bit of a hard time a couple of weeks ago. Again, nickel is a component of steel, specialist steels. Tin has been put in at the request of one of our viewers. And
Albert S.
Thank you. Ferrovanadium had a bit of a poor week, and it hasn't really moved very much over the last few weeks. WTI it's heading back towards its recent highs of just over $70 a barrel. I think Keith has got some interesting comments on that. Natural gas, which is a new entrant or relatively new entrant in our chart here, up 12%. And the natural gas pricing is extraordinary. And if it stays where it is, it bodes a very hard winter for the Western world. Coal continuing its extraordinary rise, and uranium has gone up 11% this week. Now, just talking about uranium, Keith sent me a very interesting article the other day, which basically said that Sprott, the precious metals dealer and investor, has started a uranium ETF and is buying uranium on the spot market at a very significant rate. And that the free float of uranium, nobody really knows what it is. But given the amount of uranium that the Sprott ETF is buying, as investors put money into it, it is squeezing the free float quite dramatically. And this is why the price has shot up. And one feels that this could be the start of a significant run in the price of uranium. More of that in a minute.
Okay, crude oil. Well, crude oil has bounced back from the big sell-off last month, which was mainly driven by fears of Delta variant disruption to the recovery. But what this chart shows is that oil demand in the US actually has continued to recover despite the spike in COVID cases there. And in the OECD as a whole, global inventories keep on falling. And in the US, inventories are falling and are now well below their 5-year average and still dropping. All of that is bullish.
It's a very interesting chart, the last one, Keith. So aluminium, why is aluminium soaring? Do we know?
It's soaring because the Chinese are suffering from power problems, as are the Indians. So you've had a resurge in industrial demand, and there's not the power available for everyone. And so one thing they've done is they've cut back on aluminium smelting, which is very power intensive. And so supply is dropping.
That is going to be hugely inflationary, because at this rate it will have doubled. If it continues up a little bit more, it will have doubled in 12 months.
Yeah.
And it's a massive part of a lot of manufactured goods. So the copper price is just consolidating between 4 and 4.5 at the moment. A well-earned rest, you could say, after its massive rise from just over $2 a year ago. And not surprising that it is doing this. I think, Keith, you've got some chart in here about projected future demand. So what's this chart telling us, Keith?
Okay, so this is from Fitch, and thank you very much to our Discord member, Ali Boyd, for sending this through. So we have talked in previous weeks about how going forward, copper is going to be in great demand from the energy transition, and lots of new electric vehicles and wind turbines will require a lot of copper. And various people are forecasting a supply deficit. Well, Fitch are saying that actually you're going to see strong growth in copper production. And this chart shows their expectations for copper mine production over the coming years. And you'll see they're talking about steady growth. However, the EIA have different numbers. And if you look at the chart bottom left, they are forecasting that based on the mines committed and in development, you will get a growing deficit by the end of this decade. So it seems what Fitch are doing are they're forecasting that lots of mines which are on the drawing board as possible will come into development. But in order for them to come into development, you'll need the copper price to stay high. So essentially, the way I'm reading this is that there is enough copper out there if the price is high enough to incentivize them being brought into production.
This is also interesting, Keith. You look at lithium, what the lithium chart is basically saying is there's no shortage. Am I right? Have I got that right?
No, but what the lithium chart, so, okay, the bright red line is under the sustainable development scenario, and the yellow line, so this is if we were to get to reduce our carbon emissions to the sustainable development scenario, and the orange line is under the current stated policy. So, for example, the UK has stated that it's going to have no more petrol vehicles for sale by 2030. So if you add up all the global actual commitments, you get to the yellow line. And what you're saying is, if we just stick to currently announced policies, lithium does not have a problem. If we go to like zero carbon, then we do. But the thing is, it's a real question whether that is actually a plausible line. And when we go into the current to coal consumption right now, when we've got another chart coming up, it's a big question whether anyone is committed to zero carbon. Richard.
I know it has sort of, as I said, it stopped its precipitate fall, but it may well continue it because we don't really know where it's going to go from here. It has at least stabilized. And nickel, I think, is an interesting one, as we're not forecasting a shortage of nickel until the mid-2020s. Well, not us personally, but it's not forecast. But the price is behaving as if the shortage is now. Keith, we've added tin in.
Yes, we've added tin at the request of Albert S. And tin is used in a lot of electrical connections, and it's another commodity that's had an absolutely extraordinary rise. The
ferrovanadium price is ticking down a little bit, so we will see. Suggests that demand has leveled off for it with batteries and with steel production.
Well, I think it's vast majority of it is steel production, and steel production is coming off. So, demand for vanadium is probably coming off. Although, frankly, as we have discussed previously, if there are limits on steel production and you then converted all steel to ferrovanadium steel, like doubling its strength, you'd only need half as much, solving your problem.
Yes, which would be good for vanadium.
Yeah. Now, the Dutch natural gas price is extraordinary, and what we're seeing is, so it rose over 10% last week, and this is a warning signal. It's saying that there is not enough gas in storage in Europe, and if we have a cold winter, we are in trouble. And this is so that the Dutch natural gas future has only been going since 2017, and this is the price chart since its inception. And
well, tenfold since last July.
Yeah. So all this shows that when energy becomes scarce, it suffers from price inelasticity. Yeah. And so you just need to bid up until the people who are most price sensitive stop consuming it.
The interesting question, Keith, is at what point does this happen with oil, given the lack of exploration and the closure of the running down of oil production?
Well, that is my trade, Richard, as you know.
Well, Keith, looking at this, tenfold increase in futures in 1 year.
Yep. And Shell is forecasting a looming LNG supply crunch. Now, one of the reasons I have a big oil trade is that essentially supply is now being constrained in all fossil fuels by ESG. But we're not really reducing our demand. And this shows what's going to happen in LNG. Nobody is adding supply. Demand is increasing as people switch out of coal, and also as developing markets keep on growing. And so if Shell is to be believed, very high natural gas prices could be a consistent feature of the future. And this is coal, everyone's least favorite fuel. And its price, again, is going through the roof. Mm. And the reason it's going through the roof is India. So developing markets continue to grow, and they need more power. And in India, they are growing. There are a number of coal plant power stations in operation, and their output was up 23.7% year on year in August. And India is running out of coal and will be also bidding for coal.
This is the uranium chart that we've already spoken about, and you can see there has been some sort of a catalyst in the last couple of weeks that has basically bumped the price, caused the price to go up by 20% or so. And I'm talking about all these energy prices going up. Coal, natural gas, oil is reapproaching its year high. And if the uranium price goes up, it's a very marginal cost to the electricity producers, the nuclear power station producers. And so the impact of the uranium price on the cost of our electricity is marginal. So it's interesting that whereas cost of electricity generation from fossil fuels effectively goes up in proportion to the cost of the fuel, with uranium, that's not the case, which suggests that the limit to the uranium price is not going to be the price of electricity.
Yes. Good point, Richard. The other thing I'd say is, the price of fossil fuels is going through the roof, and that's the cost of energy, marginal energy.
Exactly.
And, that will lead to increases in the price of manufactured goods.
Yeah. But it's transitory, Keith.
I hope not. I've got big investments in it, mate. Okay, moving on to precious metals, and a generally strong week, but gold and silver and the precious metals have been generally disappointing when interest rates are at rock bottom and inflation is picking up. So we have a busy week this week, so we're not going to cover them in any depth. We are going to move on to rates, and you will see that I've added the Greek, Italian and Spanish 10-year bonds to our weekly checklist, because the ECB are now becoming under pressure to stop QE and stop their extraordinary purchases of the bonds of the periphery nations. And as you'll know from watching previous weeklies, last year they bought over 100% of Greek debt issuance. So there's no real market, no proper market in the bonds of the periphery nations, and their yields are starting to rise from extraordinarily low levels. So if we look at the Greek 10-year...
Sorry, Keith, just to interrupt, but I wonder what level of interest rates the Greek government goes bust. Is it 1% or is it 1.5%?
Well, we know it's is it the second most indebted country in the world? Second or third?
Yeah.
In the UK, rates rose very slightly at the short end, but were flat at the long end. And if we move on to some charts, so this is the spread between the Greek 10-year and the German 10-year, and you'll see it has picked up recently. It's moved from 1% to 1.1%, which is not much, but it may be the start of something. just a reminder of where we are compared to history. We go back to 2015. They peaked at a spread of 17% over German rates.
So if you think it's going to go back, Keith, what instrument do you buy to harvest that 17-fold increase when it goes back to what it was then?
You need to buy a credit default swap, don't you?
I don't know.
Yeah, or you could buy an option.
Yeah.
But not really my area of expertise, Richard.
Maybe.
Perhaps one of our viewers can suggest
That'd
something.
be interesting.
Yeah.
Trading strategy. Well, this is German CPI. Now we all know that the Germans are continually desperately concerned about inflation because of their experience of hyperinflation in the interwar period, and German CPI is taking off very quickly at the moment. I think much to the alarm of the German population. And this is one from Keith, but basically it's saying that the Bundesbank had a strongly positive real rate, but it hasn't anymore. So if you go back to the mid-1990s, the real rate was significantly 3% or so above inflation, and it stayed like that roughly until the mid 2005, 2010, whereupon it's dropped below. And now they have the same problem everybody has. The real rate is 0, their inflation rate is 4%.
Yeah.
They can't put their rate up because it'll bankrupt Europe unless they pull out of the euro and reinstate the Deutsche Mark. Trouble. Keith.
Sorry.
So this is just a sort of that graph of the difference. So German real yields minus 4.3%. Spain inflation rate we covered a little bit earlier, but Spanish inflation rate is shooting up. And this is this was published in a German magazine article, and it is the proposed new 1,000 euro note with a picture of the ex-IMF director and the current head of the ECB, Christine Lagarde. So
is this serious? They're seriously talking about putting her face on it?
No, this is a joke. But
but
what it is, it's the German press getting nervous about inflation and what the central banks are doing.
Yes, as a piece of satire, Richard, this is like a typical piece of German satire in that they seem to make it effective. Surely they need a few more noughts. Shouldn't it be a 1 trillion note as a Zimbabwe?
They'd have to change the size of the text of the font, Keith. I don't think that wouldn't work on the euro note, would it? So that can't happen.
We'll see. Right. So on the seasonality chart, well, frankly, the growth in the S&P 500, it just seems to be a relentless straight line currently.
Yes,
but anyway,
the chart is now irrelevant, Keith. It is.
Yeah, well, exactly. So anyway, the chart is now saying we're in for a flattish few weeks before we get into the tribulations of late September and early October. You heard it here first. Okay, Richard, what were you up to this week?
Thank you, Keith. So obviously I wasn't here last week, and I've actually put in last week. So last week Keith had a very good week, I noticed, and I had a not such a good week, but a better week than I've had for a while. And then this week I had a reasonably good week as well, which is putting me back to where I was in week 16, so sort of end of April time. So it's sort of I think we've had a tick up in commodity prices or shares of commodity companies, and I think I reported earlier a few weeks ago I rebought into ESA, and that's doing reasonably well at the moment. So I had one purchase, Horizon's Global Uranium ETF. That should read global. Apologies for that. And no sales. And this is the uranium ETF, which has which is reflecting the price in in uranium. And my view is that if the spot ETF continues to do this, and it's going to start generating some momentum very quickly, there is a well talked about potential shortage in the uranium market, and it may just crystallize that. And I think it's worth being in uranium now for that potential move upwards. Keith.
Very good. Thank you, Richard. Well, I had a decent enough week, up 1.3%, bringing my return to 3.6% on the year. So massively below Richard, Stuart, and the All Share. I
would say, Keith, if the oil price goes up to something like $80, then you are probably going to make out like a bandit.
Well, that is the plan, mate. But, you know, so far, the oil price has gone up enormously from when I bought these oil companies. And the oil companies really haven't moved very much. So anyway, I did a little bit of activity this week. So I sold some Pharos Energy, and I'll show you the share price in a bit. And that is an oil producer with assets in Egypt. And I want to invest in some more gas companies. So regular viewers will know that last couple of weeks I've bought more Independent Energy and Harbour Energy, and another UK gas producer is Serica, whose shares I own, and I bought more Serica. Okay, taking you through some updates. Well, Rambler, which we like, whose share price has been absolutely disastrous,
makes me think of quite a suitable investment strategy, Keith, which is sell the ones we like and buy the ones we don't like.
Yeah, sadly, I think that might work quite well currently. It unfortunately has delayed the expected completion date for the new gen loan, which it needs to fund operations. That was due to be end of August and is now end of September. But I listened to an interview with the CEO who was very bullish and was sure that they were going to get the loan. Well, let's hope he's right.
That's okay then.
Yes. Now, this is news this morning, and one of the elements that is really going to be needed in the energy transition is graphite. And Armadale have a graphite project in Tanzania, which they have today got the mining permit for. However, cash on the balance sheet as of the last set of results was about 250 grand sterling, and they need $40 million to develop the mine. Now, as we have seen from Rambler and Petromatad, getting funding seems extraordinarily difficult currently, despite the massively low interest rates. So a bit of caution about buying in on what seems like a good project until they've got the funding sorted out.
Yes. And the value valley that we talk about with our mining shares.
Yes, exactly. Now, this is the share price of Pharos Energy. And you'll see the share price has been drifting off despite the elevated oil price. And I, unfortunately, added to my winners towards the top here. So I'm now selling it at a loss. And I have bought Serica, which is moving in the opposite direction. Now, Serica are 80% gas. And this week they announced one of their wells and one of the gas fields is coming online. They've managed to clear it, and they have developments coming next year and are forecasting gas production growth next year. So I will be looking to add to Serica. And that's it. So thank you all for watching through to the end of a busy week on Portfolio Matters, and I hope you all press like and subscribe to the channel. In the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.